Good afternoon, everybody. This is Christian Thwaites of Brown Janikowski. Welcome to our May market update. I'd like to thank Caroline and Neil for putting all the logistics together, and she's going to be communicating with me and us if there's any glitches. Hopefully, you can see the screen in front of you. That interestingly is a sculpture, a natural sculpture by an artist called Andy Goldsworthy. It's in the Presidio, and it's kind of interesting story about the kind of transitory effects of nature. But some of you might recognize that from the who live in the city. Okay, well, let's move ahead. So here we are in May, and just kind of give you a quick update of where we are. Now, I did originally talk about this as being the what are we going to do with the what would be the effect of these stimulus plans on the investments, and that was about 2 weeks ago. Clearly, with the big ones, the infrastructure plan and the sort of employment plan, which what its name is, but it's to do with more supports and benefits. Haven't come through yet, so we don't know quite yet what they are. But I think the concern about them being inflationary is well overdone, and I think that's going to be a constant theme of hearing me talk about today. So the stimulus that we got in place right now is the one that came through in February and March, and most of those benefits have hit already. That's been quite a quick push through to the consumer, and again, I'll show you some slides which show what's going on there. So the economic growth has started. We've seen that in the trade numbers. Now, the trade numbers, funnily enough, are actually a net negative to the GDP calculations. But what I was looking at was imports. Clearly, there's a big demand for manufactured good imports right now, consumer goods as well as other partly manufactured goods. We've also seen it in the ISM surveys. ISM, Institute of Supply Management, does a big survey of manufacturing companies and service companies once every month, and it's really a kind of optimism index, and those have been very strong, very positive for the last couple of months. They continue to be that way. The consumer is sitting on absolute record amounts of cash. Now, part of that is not an opportunity to spend what they have, and part of that is because of the benefits programs, the $1,400 check stimulus obviously being a very big one, which has been in most cases saved or to pay down debt, which is the same thing when it comes to looking at the national savings. But national savings are very high in dollar amounts, also as measured by the savings ratio, which is the difference between all of earnings and all of spending. The gap between them is the savings number. There's a huge pent-up demand for services. Goods, less so, because most people are able to satisfy their need for goods, shopping, autos, appliances, cars, houses, but services, and you can think of everything from medical care to anything which is consumer facing, the obvious ones being the leisure industry. But many of these industries may not be ready for the demand which is going to hit them. So that might cause some short-term supply issues, which you've already seen, as well as some potential inflation spikes here and there. We have 114 million people vaccinated out of a population of about 310, of which the adult population is about 280. Take away the kids and the ones which are in institutions, and you're about 270 million. So that's up 40 million over the month. So that's been an incredible rate. In fact, the level of daily vaccination declined slightly, but I don't know whether it's herd immunity or not, but it's a lot of people, and so we've had a tremendous bounce back in vaccinations, and therefore fear of COVID is on the decline. Employment is steadily increasing. The April jobs numbers, I'll focus on that a little bit, was unexpectedly low, but I think revived demand will help. Plus, there's still some dislocations in the labor market, which I think are fairly easily explained. There's no big puzzle there's no big mystery what happened on Friday. I think I wanted to debunk the theories that are around about why the number was as low as it was. The Fed is still on the data watch. There was another speech today by Lael Brainerd. She is, if you're going to follow a Fed governor other than Jay Powell, she's the one to follow. She's a permanent governor, which means she was elected by the president, or pushed forward by the president, confirmed by Congress. She's not from one of the regional feds. She's very, very good. And again, she was on quote today as saying that the inflation is temporary, transitory. Her words were transitory rather than temporary, but in fact they mean almost the same thing in terms of we're not going to see permanent spikes in inflation. Now we do have some success in the market. These were still around a month ago. Cryptos, the various SPACs, which are the special purpose acquisition companies, which kind of reverse IPOs themselves. And then we had this, big family hedge fund blow up about a month ago. So there's still some of that around. Again, I don't think it's too much to worry about. Maybe I'm a little bit being a sanguine on that, but it's focused. It's not across the entire market. And most importantly, the most important thing, I think, if you're going to sort of go around bubble watching, is to see if there's a lot of leverage in the system, and there really isn't. Let's just have a look. We seem to be in the final stretches here. This is from our friends at Pantheon Economics, and they've been doing a 3 times a week report on COVID-19 progress, support, and sort of data. And they've announced this Thursday they're going to stop doing that report. So that tells you that we're sort of in the area right down at the bottom there, where we're down almost to where we started 15 months ago, if you can believe. So and before the spike that happened in the fall. So these are the deaths that are currently hospitalized and the confirmed cases. It's really the confirmed cases that matter, because the other two are going to be somewhat lagging indicators. If you think about it, it makes sense. But the confirmed cases is now running about 35,000. Remember, we peaked 200,000. So that's a big improvement. Just to kind of show, this is where we were back in January, to kind of show where we were a little bit worried about the recent spike. And there's the United States, comfortably ahead, not in a good way, of the European Union, Italy, France, and Germany, as many of you know. That story has, I just need to change my fingers in the way, 1 second. This is, I showed the arrow from where it is in January. That's just the slide we just saw. And then you can see over on the right-hand side, here's the United States, way down. These are 7-day rolling averages of new cases per 100,000. So, you take the 7-day average, because you don't want to, there's less admissions on things like weekends. And you want to sort of do it as a proportion of population. So the United States is above the UK, but ahead of Italy, Germany, and the European Union. So as we know, the European Union was very good on the lockdown, less so on the vaccinations, and that's meant that the deceleration in case numbers with the United States has been quite a bit swifter. So the bottom line is we're in pretty good shape here, particularly compared to the big economic blocs. I haven't put China and Japan in here for obvious reasons. Problem here. This is the big states. So this is the Florida, New York, Texas, California, obviously, and these are, it's California way at the bottom there. These are all kind of going in the right direction. So you've kind of got 2 states which were fairly adamant and strict about lockdown, 2 states that weren't. I just came back from Texas and not having been out of California in about 16 months. It was interesting to see fairly crowded restaurants and people out on the streets. And that was in Austin, which is not Texas as a whole. So the point about this is that this is around about 40% of the population, 40% of GDP, and these improvements are real and getting very much better. So what's been happening in the markets? Well, the kickoff first is to look at the 10-year Treasury yield. This is kind of our go-to benchmark financial market indicators. At the beginning of the year, last year we saw rates obviously plummet from about 2 down to about 0.5%. At the beginning of this year, the rates had backed up a little to about 0.9. They rallied. You can see right here they got high as about 175. They might have touched 180 for a day or two, about a month, 6 weeks ago. But now they're down to about 1.6%. So what's the next level? I don't know. It's always a bit risky to kind of take a a guess on where long-term rates are going to be, but I would say that they're probably likely to travel within this relatively narrow band of about 150 to 180, which sounds like a big band, but it's only 30 basis points, and that can move very, very quickly. So we really don't expect the 10-year rate to change very much. And why is that? Well, first of all, big lover of history, kind of have to go back and say, well, what's been happening for the last 30 years? And so, for many of us who might have started our careers when the 10-year Treasury rate was 15%, it's obviously been on a steady decline ever since. This is a big secular change, and it's for a number of reasons, including much lower inflation, faster economic growth, more employment, more competition, trade, globalization, call it what you will. But there's lots of reasons why the 10-year nominal and real rate has fallen down. And I just cannot see it moving back up, steadily. Now, if we go back to 2010, we can see that it was between about 175 and 3%, and that might be a kind of a long-term goal here. But 4, 5, and then back to the mid 90s when it was 6 and 7 just seems to me an incredible stretch to see that likely going. If that does go on, then you can expect economic growth to be like it was in the 90s, where it was 4-5% real GDP, not 1.5, 2, which is what we've had, for most of this post GFC period up to the last 12 months, which has obviously been a huge outlier. So I think that there are a number of other influences which I think will keep inflation at bay, not least of which is wages, which I'll come on in a minute. But I think that for now, the 10-year Treasury at 160 seems about where it should be, given the outlook and given the fact that, remember, the Fed has pinned rates at the short term with the Fed funds rate, which is just an overnight bank rate, at 0%. But they're also targeting different yields. Well, they haven't explicitly said this, but the 2-year rate I think is 11 basis points or something like that. So and there was a negative 1-month bill auction the other day. So the short-term rates are incredibly low, and that means it's difficult, I think, for the long-term rates to pull away from that kind of gravitational pull of the short-term rates being anchored so low. Now we have seen some price indicators. I think pressures is a bit too strong. This is the one which got a lot of attention over the last couple of weeks. And this is the ISM, I mentioned them earlier. And one of the things they ask these manufacturing and non-manufacturing companies is, what do you see about for prices that you're paying for? Not what you're going to pass on to the consumer, what you're paying for. So if you're a manufacturer, what are you paying for your lumber or your steel or your gasoline or whatever kind of major inputs you can think of in manufacturing. And if you're a non-manufacturing company, what are you paying for your heat or your rent and things like that. And these so this is just their forward thinking about the prices that they're having to pay. And you can see the check mark up on the right hand side is pretty abrupt from a year ago. So these were 40, 50, no one was really seeing any price pressure a year ago. Not surprisingly, most of the economy was shut down. So no one's really going to pass on price increases if they've got a huge amount of capacity and no one's coming to buy anything. But recently, those have ticked up from a pretty low level. Now you can see that they've been this high before, 08, 09, the manufacturing one, back in 2010. And in all of these cases, when it was anything like these heights, it was not followed by higher consumer price inflation or producer price inflation or personal consumption expenditure inflation, PCE, which is the one the Fed follows. So this is just a kind of, yeah, it's out there, but it doesn't necessarily mean that we'll see inflation coming through in finished goods. And I think the connection between the two is far too slim to suppose that just because we're seeing this number, we're going to see higher inflation across the board in the next few months. But this is certainly one that's been catching people's eye over the last month or so. House prices have been running at about 5.5%. Again, you can see that big decrease. They were essentially flat a year ago. We've talked about housing before. There's been a much higher demand for housing. That's people trading up. They need more room because the kids are at home more, because they're not going to school, or they need a more permanent study place as opposed to using kitchen table, or they're moving out of cities, although I think that that's some of that second homes, and that's not really a big exodus, but there are also definitely some people moving around. But the big thing, remember, is that the house demand far exceeds housing supply. New homes take a while to sort of get going, get up to the rates which people want them at, and in many parts of the country, including around here, there's big restrictions on putting up new housing. Crazy social policy, but there you go. It essentially means that it pushes up house price inflation. I think these will start to ease off a little bit, not least because I think a lot of the big moves have been or already happened, and mortgage rates have started to increase a bit, because at the beginning of the year, the mortgage rates, which were all pegged off the 10-year, were probably just under 3%, I'm guessing, for a 30-year, and now they're more like 3.3, 3.5. I mean, that's still below the rate of increase in a house price. So, buying a mortgage, you're buying a real asset which is increasing more than what you're paying for it. But that's enough to tip people who might have just qualified or just been able to make it, with a higher mortgage payment. They're just backing out of the market. So we expect some of the housing numbers, whether it's new housing starts or purchases of new homes or purchase of existing homes, to flatten out a little bit. This is a big one. This has got a lot of attention, quite rightly so. This is lumber prices. So the average house in the United States costs about $200,000 to make one, maybe a little bit higher, $220,000, let's say. And it used to be that the construction costs were about, this is aside from the land cost, but the construction costs were about $20,000. Sorry, the lumber costs were about $20,000 of the construction cost. So the material to put into a house, the lumber cost you $20,000. Well, now it costs $50,000, $60,000, just because there's been this enormous spike in lumber. Now, some of this is that tariffs were put on. I mentioned this before, which screwed up the whole market. Some of those have eased off. So that was importing from Canada was more difficult. But the big thing is that lumber mills got really scared out of their minds in 2008, 2009, because the housing market obviously collapsed, and new starts went from 2.2 million to less than 800,000. So a lot of them were sitting for a long, long time. That's made them very wary to expand more than they feel is prudent. So I think what's happening in the lumber market, a little bit of a bottleneck, is that housing builders, and suppliers kept their inventories low. There was this pickup in demand. The mills didn't fully come through didn't expect the demand to last, so they didn't have as much capacity open as they used to. So they jacked up prices, and it's just a standard sort of supply demand problem. But I do think this will ease down a bit, because with these types of lumber prices, the mills are very incentivized to open up capacity, bring more people into work, open up idle plant, make new plant if they have to. So I do think that this is very dramatic price increase, but it's again, part of the housing story, and part of the fact that the market almost pretty much closed down. If you see that in the beginning of 2020, the lumber prices almost halved from about 450 to 200. So this is a kind of a pickup from that, and then just the spot rates getting up. But I think this will ease. The other thing that's going to happen is that this is the one-year inflation number, 1.65. This is just the core one. There's another number tomorrow. I think it will be a little bit higher, but not aggressively so, because we kind of got these weird base effects. Even if prices don't change at all for the next 2 or 3 months, we'll record a year-on-year inflation number, the headline number. This isn't the headline number. This excludes the energy and food, of about 2.5%. That's it. No price changes, on a monthly basis, just because of what it's comparing it to 12 months ago. So it'll be interesting to see. I think it'll be a little bit higher tomorrow than 1.65, but I don't think it's going to surprise way to the upside. If we saw core CPI tomorrow at 2.5, 2.5, that putting a bit of a dent in the bond market, possibly the equity market, but I don't think it's going to be that high. Not that we've got any bets to depend on that coming out. And then we've got here, put in just some, the CRB is just a commodity spot index that throws in a bunch of different commodities, hard, soft, food, metals, lumber, nickel, that kind of stuff. So, it's they have increased about 45%, as you can see, but I think that, again, that's partly from where they were 12 months ago when everything collapsed. So we've got a couple of inflation indicators in there, and if I feel like I'm sort of like just dismissing them as being temporary, I think that they are there. I'm not sort of wishing them away, but I just don't really think that they're going to last, as in they're going to jump to a 4% plus inflation level, for a long time. I think that's what you should be worried about as an investor, not transitory, whatever they're called, temporary spikes in inflation, which is very much what we're getting. This is the important one now, the employment cost index. Now, let me just kind of take you through this. This is very interesting. This black number is the average, black line is the average hourly earnings. And they spiked, last year. This is actually a logarithmic chart. So this number, about a year ago, average hourly earnings were increasing about 8%, which freaked everybody out. But as we mentioned at the time, that's because the lower paid people lost their jobs in a much higher proportion than normal, average, or higher paid people. It's dropped out of the market. So people, with an average weekly wage of for 400, 500, 600, as opposed to the average, which is 1,100, just came out. So you were left with a pool of people who were, higher paid, and it looked like they'd all had pay increases. Well, they hadn't. It's just that a large majority of the population, 22 million people, lost their jobs, and so they weren't counted anymore. Now the reverse is happening. So last Friday, what we saw was this 0.33%. So what was happening was some of the people, again, particularly in the leisure and hospitality industries, were coming in from the bottom and getting back their $400, $500 a week. And so they're now back in the pool. So it looks like average hourly earnings have only increased about 0.3%, which is actually one of the lowest numbers out here for the last 15 years. But again, we've got to wait for this to kind of sort itself out. You've got a workforce which looks like more like it should be, and with more of the workforce in place for a longer period to figure out what's happening with average hourly earnings. But they're not rising at 8% last year, and they're not rising at 0.3% right now. The number's probably pretty much what this blue number is, which is about 2.73%. Now, we only get these are called the employment cost index. We only get those quarterly, whereas we get the average hourly earnings monthly. But it does show that as of the first quarter, employers were not looking at huge amounts of wage costs. Now, these could change, but 2.73% is what it was pre the GFC, the great financial crash. A little bit higher than what we saw in 2010 to 2016, but boy, again, nothing really to get too concerned about. But you'll hear a lot about this as well, and I'm again trying to show that this is different from a year ago, but not necessarily different from 5, 10 years averages. Now, the April job numbers were way too low. There's no two ways about that. Again, this kind of weird graph, which has got this strange y-axis on the right-hand side. So here's the 22 million people that lost their jobs in February, March of last year. We've gone back to levels that have hit as high as 900,000, but last Friday was at 266,000. A lot of people were expecting more like 700,000, 800,000. 266,000 is a perfectly good number in a normal recovery. So this is exactly what it was for most of this period, somewhere between 150 to 260,000. So why was it so low? Well, a couple of before I go on to that, just say the unemployment rate, the real unemployment rate, the published one is 6.1. The real one's about 10.4. It's come down a little bit, but it's probably still about understated. So what happened with those payrolls? Well, first of all, it's 1 month. There's an awful lot of noise that can happen in 1 month. When new farm payrolls used to be 150 to 200,000, you would see regular revisions of 25 to 50,000 up or down in the next couple of months. And they get revised heavily. There isn't a single non-farm payroll print which has not been revised by at least 20,000 in the last 20 years. So the first cut is a little bit of an average before they kind of get all the final numbers in. So there is a plus or minus on this number of probably around 50,000. So to kind of settle down. These can be very noisy, so we need a couple more months to see if there's a trend here. The second point I would make is that COVID is still around. And if you're in a profession or want to go back to a profession where you're potentially very exposed to it, nursing home care, obviously it comes to mind. There's plenty of others, which I'm sure you can think of. It's still a risk to go to work. And the survey for the April jobs numbers, which published last Friday, was done on April the 12th. And that was before the universal vaccines came in. Up to that point, it was sort of like the most immediate in need. You probably had them yourself. It was okay, we'll do people in the 70s and then 60s, and people with other afflictions, and people who are maybe got comorbidities. And it wasn't until, gosh, I think at least the third week, maybe later, where kind of universal vaccines came in. So a lot has changed in the 1 month, and the vaccination rate, as I mentioned before, was up 40 million in the last month, and I don't think that would have been picked up in the survey. Now, there is still a mismatch in skills and location. So some jobs may be open where people aren't, they're not located near them, or most importantly, they can't get to them. I mean, transportation capacity has dropped by a lot. Now, I've looked at the New York subway numbers. They're still 20-25% below. I'm sure things like buses and trains are on limited schedules. So there is really a problem in that people might want to take up work, but they're not necessarily in the right place, or they can't kind of get to it quite yet. That will even out, but it's still, an issue right now. Women in the labor force. This is just sort of heartbreaking, really, to talk about the labor partition into women, which peaked 20 years ago, has been declining ever since. But it's way below what it was even a year ago. So we're still about 8 million jobs less from a year ago. So we had 22 million people who lost their jobs. Some people exited the workforce. But the number of women in the workforce was about 5 million higher a year ago. So that's still, why it's, obviously home care falls a lot more on women than men. It might be the kind of jobs are there, but that will kind of rectify itself, I think, over time as some of these issues go away. Many people are just stuck. Schools aren't open. Can't afford childcare because there aren't any childcare, so you can't go to work. It's simple as that. I mean, and until you see some of this all opening, I think we shouldn't be too surprised here, because the opening is not going to be the same as the closing. Closing a year ago is like a steel door came down, shut everything up, shut everything down. But people aren't going to go back just like that, just because they say, well, the vaccine rate is fine, and you don't have to wear a mask in Texas anymore. So it's going to be a gradual opening, because people have got to sort of fix all the living and work standards which they've had for the last year or so. So again, I think that will begin to rectify itself as some of these things ease up, particularly the school side. But what it's emphatically not about, and I'm sorry, but I'm going to just dwell on this for a second here, is that there's excess unemployment insurance benefits. So the story goes here. It's a bit like the old welfare queen accusations from the 1980s, is that people are sitting at home with their unemployment checks, plus the $300 supplement, plus they got a $1,400 payment, and they just don't want to go to work. Well, that's just patently not true. Anyone who's been out of work for a while or been on unemployment benefits know that these don't remotely come close to what a full-time job can offer. The average unemployment benefit is about $20,000 a year. The average wage is $52,000. So, maybe at the margins there are a few people who, maybe younger people who take the summer off, but really the unemployment insurance benefits, range from $70 a week. In places like Oklahoma, I can't remember who's the lowest, but one of those states, it might be Louisiana, but to a high of maybe 300 or 400 in Oregon or Washington. I can't remember what it is. So they're all over the place. But mark this: those are just averages, and they're based off prior pay. So there's no way people are getting $700-800 just to sit at home. Last year there was a survey done when the supplement was 600, not 300, and it showed unequivocally that people were looking for jobs as hard as they could. They did not want to be, just taking unemployment benefits. They didn't want to lose contact with the labor market. And that's very important. If people lose contact with the labor market, their skills atrophy, or the people they knew move on, or the bosses, rehire and don't hire them because they weren't around. That's a real fear for people. So I think that this is a very much overblown statistic here. Yeah, sure. There were some people who said, well, I have a restaurant and I can't find people to work it. And there's plenty of anecdotes like that. But I'd say that, those anecdotes don't sum to, an entire workforce of 156 million people. And it also suggests that those companies probably need to increase their wages a little bit. A lot of them are still paying $7 still minimum wage in this country, but it's $2 for restaurant workers. So, I would say that supply demand issue probably has to rectify itself. But those are my thoughts on it. But I think the takeaway from here is that the payroll numbers, let's give them a few more months before we freak out and say that it's not, 250,000 isn't enough. 250,000 isn't enough, but I think it will come back to a higher number. Yeah, this is just another way of saying actually what I just said. This is the U.S. employment ratio. So, back in the late 1990s is when women participation was peaking. 64% of the population was working. It crashed in the GFC to about 58%, climbed steadily back up. Then we hit COVID. It plummeted to 51, and today is 57. So I think it's going to recover a little bit. This is just the population of the United States. Again, not the kids, not the people in institutions, which is the military and stuff like that. But it's and the number of people working at that. So you never get 100% because some people are too old, some people are too young, some people are in the wrong place, some disabled and so on. But it obviously peaked at a much higher number than it is right now, and I think it'll start coming back. And then the unemployment rate's about 6.1. So these normally you'd expect these to move a little bit separate from each other. Right now they're kind of converging in the middle. So I think the the labor supply still needs to get back in balance, which is what I've talked about before. Now labor demand is actually pretty high. So we had this morning the job opening numbers for March. These job opening numbers are always a month later than the actual non-farm payrolls. So here we go, 8.1 million. They've only been doing this statistic since 2000. They don't go further back than that. You see there's 8.1 million jobs open right now, and there's about 9.5 million people unemployed. So that's a very high ratio of, this is the number of, down here, I've put the ratio of job openings to the number of people unemployed. So theoretically, if there's 9 million people unemployed and 9 million job openings, it's kind of one to one. And it's a little bit less right now, but it's a lot higher than it was for the 6 or 7 years after the GFC. So it's so the labor demand is out there. Again, why isn't it being filled? I think it's all the reasons I just discussed, and I think we've got to give it a little bit of time. But this shows me that companies are beginning to say, hey, we need workers. Now they might have a problem in that they're not paying enough, especially if you've got to wrestle someone away from home who's thinking, well, I've got to pay childcare. Childcare in the Bay Area is some astronomical number, so you've got to clear that. And the other kind of break evens, well, I got to get to work and I've got to buy other services I wouldn't do if I'm not working. So it might be the fact that the employers are just not paying enough right now. But the good side of this, at least the demand for labor is in pretty good shape. Now GDP, these numbers were 4% and 6% a year ago. A month ago. So we were looking at a 4% GDP. This is this blue bar, second to the end. And then since then, the first quarter numbers have come out at 6%. So that was higher than most people thought. And right now, the Atlanta GDP now guys who take a kind of spot estimate of what GDP they think is going to be GDP. If you kind of look at their numbers, they revise them up and down. It doesn't look like they have a lot of relationship to the blue numbers, but they do by the end of the quarter. So right now, the Atlanta GDP is fairly bullish and expecting second quarter GDP to be at 11%. I would say it's probably going to be near 11 than 6, just because of the reopenings, and we're still early into the quarter. We've got another 2.5 months to go. So, but I think this is all very good sign that the GDP and growth is heading in the right direction. This is the level of savings. It's just kind of mind-boggling here. The savings ratio is the yellow line. So normally it ticks along, depending on if there's a recession or not. It's lower, obviously, in non-recessionary times. But the savings ratio in the US has been 4 or 5% for as long as I can remember, way beyond before this 1991. So the last 12 months, it goes absolutely haywire. You know, spiking as high as 30%, then down when the employment benefits weren't extended. That's from about June, July last year through till December. So savings will run down to 15%, still twice, nearly 3 times what they used to be. And then the last personal income and outlays report for March are 27%. So again, it's this issue that, you know, people are at home and earning but not spending, or they receive benefits, the $1,400 stimulus checks, and they're not able to spend them. So they're saving them. Some of them saving out of fear, some of them saving them out of necessity, some paying down debt, some just because there's really not a lot of opportunity to spend it. But what's showing up here is the personal savings, you know, $6 trillion. Now, US GDP is $22 trillion. So there's a kind of, you know, $6 trillion, which is not being deployed into the economy right now. Now that number won't go to zero, of course. You can see that if you kind of look back at it, you know, maybe 1 trillion is more of a kind of a normal savings number, but depending on the level of interest rates. But this is obviously a heck of a lot of spending power, and some of it's going to find its way into the economy, not just some of it, quite a lot of it. Now, let's turn our view to the stock market. So we kind of got a good GDP, a questionable payroll number, but I think it's going to get better for the reasons I mentioned. Huge consumer number and savings number sort of pent up. So how are we doing in the equity markets? Well, some areas are definitely in bubble territory. For those of you, I couldn't watch it, but some of you might have watched Saturday Night Live with Elon Musk, where he talked about Dogecoin, sometimes pronounced another way. It was a hustle. But you've kind of got these bubbles in a number of areas. Electronic vehicles is certainly one of them. There's about 20 companies in the electronic vehicle space, of which Tesla's the most famous one, but certainly not the only one, you know, which have had incredible runs. But this is from the Fed's and quarterly financial stability report, which came out yesterday. It's kind of interesting reading. I invite you to look at it on the Federal Reserve site if you have time. But anyway, they do talk about asset prices. They're not, people think they're indifferent to what the stock market's done. They're not. They pay a lot of attention to it. Housing markets as well. So this is one of their kind of lines from yesterday. Valuation for some assets are elevated relative to historical norms. Asset prices may be vulnerable to significant decline should risk appetite fall, which I would say, oh yeah, that is exactly right. And so I've taken here just some of the more bubble aspects. I mean, there are others, but here we've chosen, you know, first of all, this top line is the Arc Innovation Etf. Now, you might have heard about Arc. Essentially, they're highly concentrated tech growth. They own companies like Tesla and Square and you know, battery makers, and I can't remember what else, but very, very concentrated. So an ETF might only have 30 or 40 holdings in it. And they've done very well, but you know, they're full of highly volatile, high beta, very highly valued stocks. So back in February, you know, if you bought it, say at 158, it's worth 107 now. It's quite a big correction for an ETF. Hell of a big correction, actually. And then the other one is the Ipo Index, is an ETF which just invests in IPOs. So so obviously it's trailing, it's picking up all the IPOs from the last year. I think it just sells them after 2 years. But again, you know, the peak of that was about 140 in February. Now it's 103. And then the final one is there's an ETF. There's an ETF for everything, unfortunately. Some of them are really pretty dangerous vehicles, but this one is an ETF which just invests in SPACs. Now these SPACs again are just empty shell companies waiting to buy a company and get a reverse listing. But when you buy them, you're just buying a bunch of cash, and then depending on what they end up buying, you end up with a company which may or may not have a future. But so they are kind of speculative because you don't know what you're buying. And again, the peak of that was about 142 again in February, and today they're 95. So these are big losses, and there are other ones as well. But again, I don't think it's not broadly spread around, but as you know, and if you follow the crypto space in any way, shape, or form, you know that there's been similar stories over there. This one I've showed you a couple of times, but this is the 2020. This is the S&P index versus the equal weighted index. So the equal weighted is just the 500 stocks, and every stock is weighted 0.2%. Whereas in the other normal S&P 500, you get 5 stocks which are worth 16, 17%. I think the large tech stocks and everything are even higher than that. So one is much more concentrated than the other. So what we've seen recently is that last year was very much a story of the large caps beating everybody, the average S&P 500 stock. That's reversed. In the last 6 months, we've seen the average US stock, quoted stock, up 120, that's up 27%, and the S&P, which is market cap weighted, up 19. So that's good news. What does it tell you? It just tells you that more companies are participating in this rally, and that's a good thing. Last year, we were talking about this is a good market, but it's very, very focused in 5, 6, 7, 10 plays, and now we're seeing it broaden out, and that's been a story for a while. Glad to see it. Yeah, I'll skip this one. This is still a similar story. But we've also seen market cap rotation for us. Last year, the S&P was, which is the bottom one here, actually that's the top 5 companies, and then you got the S&P as the red number. We're way ahead of the small cap and mid cap, and now that's reversed again. So for the last 6 months, the small caps are up 34%, mid caps up 29%, whereas the top 5 stocks are only up 13%, which is, I know only is kind of a funny word to put in front of a 13% return in 6 months, but we have seen this big rotation out of small caps, and it's taken a bit of a breather recently. You can see this line has essentially gone sideways since March, but we think that's still got more legs to run. And then sector rotation as well. So sorry, it's a pretty ugly chart here, but the top chart is what happened in 2020. So down here you've got consumer discretionary. I can't remember what the C stands for, but anyway, these are the Amazons and Apple. Amazons and Netflix, and then technology areas. So these were up 35, 40%, and you had telecoms dragging its heels, consumer staples, and others, up 15%. Now look at 2021 year to date. It's seen a complete reversal. So energy didn't even make this top 10 here. It's up 45%, which is as much as the tech stocks were up last year. So there's been a big change around the leadership and industry of the market, which again is good. But we don't want to see a market which is led by a narrow group of companies. That's fine in a revival, because some are going to be faster off the mark than others out of a recession. But if you see a market which is too top heavy, it's a bit risky, but it's broadened out. And also this one, which is the cyclical stocks. This is the Dow Jones Transportation Index. So this is full of things like airlines, FedEx, UPS, JB Hunt, which makes trucks. You probably see them on the road. Kirby, which makes barges, go down the Mississippi. Anything which kind of moves stuff from A to B. CSX, I think, is one of the railroad stocks is in there. Anyway, that's been a much stronger performer than the S&P again over the last 5 or 6 months. This is kind of the cyclical, broader parts of the market, coming back. So in a market like last year, Facebook grabs all the advertising. In a market like this year, JB Hunt is moving stuff for everybody. It's moving stuff, for industrial companies, for manufacturing companies, for service companies, for furniture, people, always not people, but for furniture, big items like that. So it's indication of a much broader recovery, which is again what we want to see. I'll talk a little bit about corporation tax. I think it's complete red herring, the whole corporation tax. for most of the post-war era, corporation tax was even higher than I'm showing here. Here it was in the 80s and 90s, never much below about 30%. This is the effective rate. The actual rate is higher than this, but if corporate tax is unlike personal income tax. You can make it lower by spending more and investing more. You can't do that with your income tax. So companies never paid the full amount, which is fine because they're investing and paying people and they've got lots of tax deductible expenses. But you'd be hard pressed to see any link between the corporation tax rate and the S&P. They just don't seem to be affected one way or the other. And I believe that that's still the case today. When we saw the Trump tax cuts take it from, I don't know, like 35 maybe, the statutory rate. In fact, it was more like 15, 16 on the effective rate. They took it down to 21. What happened was you just saw more share buybacks, but that kind of was pretty ephemeral. It was kind of over in 6 months. So I think with the S&P 500 companies paying 12.85%, if the rate goes up to 25%, which is what I think the senator from West Virginia wants, or 28, which is what Biden wants, it's going to make very little difference to this. Also, 95%, only 5% of US companies are incorporated. 95% of businesses are LLCs or S corporations, which pass on their income to owners through personal tax rates. So this is not a big deal if corporate taxes go up to 25, 26%. Although I've seen some analysis which kind of just chops it right in and says, well, that means earnings per share are going to be down 10 or 15%. I just don't believe it. Just because if you're a good CFO, you can manage your corporate tax rate to a lower rate. So I think that's something not to worry about. This is to kind of look at our own evaluation metric in here. So there's dozens of ways to value the equity market. No single one is bulletproof, but kind of like this one, which is the earnings yield, which is just the price earnings ratio inverted, and we just take away the inflation rate. Sorry, the 10-year bond. So it's about 3% right now. So a little bit cheaper than it was actually, fine enough, 2 or 3 weeks ago. Because rates have come down. It's not out of line. I mean, you could scare yourself and say, well, it's the lower the number, the more expensive the market is, and so it's not down to where we were in 2000, thank God. But it's not incompatible with the market going steadily along. And I think that's just generally the story. That you can take the CAPE, the cyclically adjusted PE too. Again, quite high, but doesn't necessarily mean that the next 5 or 10 years are going to be flat. So I think we have to accept the fact that valuation is a little bit high, but not to the point where they're in nosebleed territory and screaming to sell. So let me wind up here. I think the fiscal stimulus will be less than the headline. Obviously, there's some bargaining and negotiation going on. It seems like the White House has been pretty open to that. The Republicans have come up with their own infrastructure bill. I'm sure they're going to meet in the middle somewhere. Something's going to be done. The consumer is ready to spend, but as I mentioned earlier, you can't just open up suddenly and anticipate 12 months of you got to wear a mask, 12 months of you got to stay distant from people, 12 months of don't gather, 12 months of stay at home, 12 months of all these things which happen, which shock people, can't just open up quickly. So I think we have to accept the fact that the opening up, while positive and slowly coming our way, is not going to be sudden, although I do think the next couple of months we're going to see a big revival in consumer spending, because based on that amount of savings that we have. Inflation will persist, but the thing to look for is wage growth, and so far that's been pretty non-existent. It could tick up, but I'm kind of with the Fed on this. I think a lot of it will be transitory. If it stays at 3 or 4% for 4 to 6 months, then we might have a problem. The Fed will hike rates, but I just don't think that that's likely. I just don't think it's likely. Supply will come back onto the market for the reasons I described. Again, people are kind of reorienting themselves to a different set of circumstances in the labor market. The Fed's going to stay on this. We're going to stay low. We're going to continue to stay low with rates. We're going to stay with zero rates. They'll signal on the QE side way before they do anything with rates. So their first thing is going to be, well, we're going to not reinvest the coupons on the Fed balance sheet, which is we've got $6 trillion worth of mortgage-backed securities and treasuries. Then they'll talk about cutting back the monthly purchases from the $120 billion level. Then they might talk about just a different type of QE portfolio, and then they'll talk about raising rates, and then they'll raise rates. So we could be talking a long way out. They do not want a repeat of the 2013 Fed temper tantrum, where the market and the Fed misread each other. So I think this will be incredibly well telegraphed. We've got a pretty transparent Fed right now under Powell. The market has some bubbles. I think caution is definitely a watchword worth keeping. We should be patient with the market. I do think that we're kind of overdue for the market to go sideways for a little bit. It's been very strong through this earnings season, but I think it's in fundamentally good shape. There's no reason why we shouldn't have a little bit of a pause for the next few months. Good. Well, thank you for your patience here. I'm going to just switch this off, and I know we have a capability for some questions. I think there's a question text or chat if anyone has one. And Carolyn, I don't know if you can hear me. Should I just thank everybody for their time? And if you have any questions which occur to you. Okay.
Yes, Christian, no questions at this moment, so we can sign off if you're ready.
Okay. Well, thanks everybody. And again, just feel free to barrel questions into me at CTHWAITES, CTHWAITES, at B&J Advisors, or your financial advisor. There's always ways to get through to us or on our website. And thank you very much for your patience, and I look forward to speaking to you next time.
In this commentary are only several of the successful as well as unsuccessful investments by us and do not represent all the securities we have purchased, sold, or recommended. Although we deem reliable the sources of statistical and other information referred to in this commentary, we cannot guarantee the accuracy or completeness of any statements or numerical data. Past performance is no indication of future results. Thank you.